Hello, everyone. Today on the Final Bar, I'm joined by Ari Wald from Oppenheimer, joining us from the New York area. We'll talk about this overall market environment. We've been discussing sort of the overall big picture. We've certainly seen some short-term weakness, seen some short-term distribution in the S&P, the major averages. What differentiates a short-term pullback within a long-term bull trend and something deeper and more sinister? We'll try to unpack all of that and more. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity of the markets using the power of technical analysis, using data visualization techniques to better understand market dynamics. I was taught early on that if you know nothing else about the market conditions, nothing else about the macro environment, you have one thing to help you understand the S&P 500. Look at a chart of the S&P 500 and just look at the price. All the other stuff is noise. All the other stuff can help you understand it, validate it, make sense of it. But at the end of the day, focus on the trends and make sure you're leaning into what's working, leaning away from what's not working. And I think in an environment like this, where you're seeing some short-term distribution for sure, we saw sell-off yesterday through the course of the day. Today, really a choppy session, but finishing, overall sort of in a position of weakness with some defensive sectors like real estate and utilities at the top of the list for today. Overall, it's about relating the short-term distribution with the big picture. What is the overall trend? And when we look at charts of Home Depot or charts of Facebook, charts of some of the banks, these are not broken charts. These are charts that have pulled back. And I think at the end of the day, it's all about defining your level of risk or your level of perceived risk. At what point do you decide that a pullback is too deep and too painful to start to rotate to a more defensive position? We'll try to unpack as many of those ideas as we can. Now, we have great guests on the show. I'm excited to have Ari Wald back on the show here in a moment. I also want to let you know, Wednesday the 13th, we have Clint Cowles from TD Ameritrade. On Thursday, Jeff Hughes from JWH Investments in Minneapolis. Coming up next week on Tuesday, we have Katie Stockton from Fairlead Strategies in Connecticut. On Wednesday, Ms. Schneider, founder of Market Gauge and host of some fantastic shows and guest appearances on StockCharts TV. A lot of great guests coming up. I'd encourage you to check out our previous interviews on StockChartsTV.com. Also, as a reminder, my next webcast will be coming up next week, 1 week from today, on Tuesday, October 19th, 1 o'clock Eastern. I'll be doing a special webinar talking about this pullback environment and thinking about 5 charts to follow to understand why October may be the ideal time to be long, to be planning on strength through the end of the year. We'll talk about the short-term weakness with the long-term strength and the seasonal trends going through the rest of the year. For more information on that, go to marketmisbehavior.com/October. I want to continue on with our market recap. We're going to talk about a poll first we asked you recently, and this is sort of a behavioral finance 101 question. I love these, and I hope you find them interesting. You struggle to sell a losing position basically because of an emotional connection to the position. Which behavioral bias are you demonstrating? I almost tripped up Final Bar Nation here. The correct answer was endowment bias, and 31% of you correctly answered that. I got a bunch of you to answer some incorrect ones. Confirmation bias, selling bias, which is not one that is actually a bias. I actually made that one up. So I got you with some of you with that one, and then narrative bias. So the endowment bias or the endowment effect is basically what I'm referring to there. And that's basically where you have an emotional connection to stocks that you own, to your portfolio. And when you own Facebook and it starts going down, even though the chart tells you to sell, you hold on to it because it's Facebook, it's your stock that you love, it's done so well for you. And as a result, you hold on to a losing position. That's called the endowment effect. It's where you basically endow these inanimate objects with greater value because that's something that you own. Confirmation bias, very closely related. That's actually where you determine your point of view ahead of time, and then you start to confirm that, or you try to confirm that by gathering evidence first, instead of reversing that, gathering the evidence first and making the decision. If you don't know some of those biases, I would encourage you to read up. Our chart school articles on StockCharts.com do a great job of explaining them and how to recognize them in your investment process. Let's continue on with today's market recap. So as I mentioned, the S&P really in a choppy mode today, had some signs of life at times, but at the end, it was sort of an unchanged day, sort of a sideways day, feeling some weakness into the strength. And it's interesting, we've seen this pattern of distribution. One of my questions here later in the final bar mailbag deals with that distribution that we've seen in the last 30 to 60 minutes of trading. So I'll save it for them, but I do think there's something to be made of the sell-offs going into the close. It's interesting to see today you had mid caps and small caps in the green, the S&P in the red, the NASDAQ in the red as well, and the VIX is back below the 20 level. Other asset classes, interest rates were flat yesterday because the bond markets were closed for the Monday holiday. Reopening today, and you can see that interest rates coming off. So the 10-year yield is back below 160, ending the day around 158. And the TLT, which we usually use as a proxy for bond pricing, really bond prices really accelerating to the upside through the course of the day. Commodities overall were mixed, and you had things like crude oil sort of flat, copper down today, but gold and silver were in the positive. The energy sector was sort of in the middle of the range today, unchanged for the day for the most part, and commodities as a whole were really choppy, sideways session. Cryptocurrencies rotating lower, and this is after coming off of some incredible upside runs. So you had Bitcoin touching 57,000 plus, nearing 58,000 yesterday as we were recording the show, now back down below 56,000 and nearing 55,000 as we're broadcasting this live just after 4 p.m. Eastern. So overall, you're seeing some short-term distribution. You know, I in general tend to describe things in terms of the path of least resistance, and it certainly seems, looking at the chart of Bitcoin, you see strength over weakness overall. But days like today certainly make you think about some of the downside objectives. I think that 55,000 level is an interesting one to see what happens overnight session here relative to the normal equity trading session. Let's look at a chart of the S&P 500. And again, what we've talked about many times on the show, at some point we will have t-shirts made up that say the final bar and higher highs and higher lows on the back of it or something like that. So as a constant reminder, my wife tells me I use that phrase way too often, but I think there's a reason for that. In general, I think we get way too caught up a lot of times looking at details, looking at the flickering ticks on the chart, looking at a lot of technical indicators if you use those sorts of tools. But I think at the end of the day, you're best served by just looking at the trajectory of the price. Is this price making higher highs and higher lows, or is it not able to do that? And that tells you a lot of what you need to know about the characteristics of the chart. When I'm looking at a daily chart of the S&P 500, I think it's pretty clear you've transitioned a chart in a clear uptrend of higher highs and higher lows. It has been incredibly consistent through most of 2021. I think you saw a change of character in September where that pattern has broken. We've broken down below the 50-day moving average. That seemed like the impervious level. We would never close below 2 days in a row. That's now happened, and we've seen some short-term weakness. We've gone from a pattern of higher highs to lower highs, with the lower high in mid to late September being pretty key, and now another lower low going into this week. We have lower high. We now have lower lows as well. We've undercut the August low. We did that a little bit in mid-September and certainly in late September, and now we've made a lower high, and now we're rotating back to the downside. So until that pattern stops, right, how do you tell when this downtrend is over? You know, the S&P trying to make a lower low and failing to do that would certainly be one indication to me that we may be seeing a short-term bottom, some sort of short-term support. We haven't seen that yet. We've seen the S&P going lower. The RSI remains below 50. So overall, this is a chart in short-term distribution mode. When we look at the long-term trend, though, the weekly chart, it's pretty clear that this is still within the context of a long-term uptrend. And when I think about now and year end, I mean, those are sort of the things that I would be wanting to think about as an investor is, you know, what is the short-term weakness versus long-term strength that we've seen in these charts. Even this short-term pullback that we've seen is still within the context of a long-term uptrend. On the weekly chart, you don't really see lower lows, right? You see higher lows when you look at the longer-term trajectory of this price behavior. So I think making sure that we recognize the difference between the short-term pullback and some of the long-term indications is vital, especially when the market's in pullback mode. A couple things to highlight before we take a quick commercial break. I think when you're looking at the sector rotation picture, and I was just talking with Julius DeKempener, we're going to be doing a presentation together for the Money Show a little later this month in October, actually early November, and we'll be letting you know as soon as all of that is confirmed. We talked about sector rotation. We were talking about some of the themes that we were looking at, and I think it's very interesting to me on a day like today when things like real estate start to show signs of life. Things like utilities outperform, or actually are in the positive, and the market overall is in the red, right? Looking at outperformance in real estate, this was a story that we saw, consistent outperformance in real estate. And if you start the clock, or you end the view sort of May, June of this year, real estate was actually one of the better sectors out there. If we look at the XLRE, stop the clock here in June, July, real estate actually outperformed pretty much everything, if I remember right, or very close. It had to be one of the top sectors, one or two sectors here in June, as it's making new relative highs, new price highs, and not all the sectors were participating. This is when the growth trade was kind of struggling a little bit. The cyclicals are really leading. This is when energy, financials were really making new highs here, especially into May. You had real estate making new price and relative highs in June, but look at how the characteristics of that chart definitely changed. While real estate continued to go higher, the relative strength tapered off, and now overall has been declining a little bit. So today's bounce is just this little bit of a bounce higher in the relative strength of real estate. When I'm thinking about signals to get more defensive, when I'm thinking about signals to be more cautious, real estate, the relative strength making a new high for the year would be one of those things that would tell me, wow, people are really getting into a fairly boring, fairly defensive part of the market right now, just like they actually were earlier this year. So certainly could be a chart to look at, and utilities absolutely the case, to see if you see the relative strength start to improve over there. We need to take a quick commercial break. We'll be back with my guest, Ari Wald. We'll see you in a minute. Everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using technical analysis, behavioral finance tools to better understand investor psychology and investor behavior. A couple quick announcements before we get to today's guest, Ari Wald. First off, we'd love to get your questions. We're going to be answering questions from the Final Bar mailbag a little later in today's show. We'll do another one at the end of this week, and we would love to answer your question live on the air. The way to get your questions to us, three ways. Number one, via email, thefinalbar@stockcharts.com. Number two, on Twitter, @finalbarsctv. Finally, on our YouTube channel called Stock Charts, just check out our videos there. Put a comment below the video you're watching. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment on Friday's show. Also, do me a favor, go to stockchartstv.com. That is our on-demand platform. You can use your email address, set up a free account, start watching all of our great content on demand from our website and also from your mobile devices. Great guests like Ari Wald and others, special events like The Pitch and our year in review coming up in December, and all sorts of great content every day and every week. Go to stockchartstv.com, or on your mobile device, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Ari Wald. Ari is the technical analyst at Oppenheimer, coming to us from the New York area. He's very graciously come on our show a number of times, always brings some charts that help us think and put things into proper perspective. Ari, welcome back.
Hey, always a pleasure, Dave. Thanks for having me back.
So as we were talking earlier in the market recap, I think a lot of investors are struggling with sort of this situation, right? The trend has been so overwhelmingly positive for so long, and now we're seeing, certainly in the short term, some signs of distribution. Start us with your first chart. We're looking at stocks above the 200-day moving average. How are you making sense of this market right now?
Yeah, well, I was looking back at my notes from when I was on last July. We thought that the bull cycle was intact and that a better opportunity would be presented later in the third quarter. And fast forward to today, the S&P is essentially unchanged over that time period, but we do think that that opportunity is being presented based on market internals rather than anything that's going on at the headline level. So we do have this chart showing the percentage stocks on the NYSE above their 200-day average. So we're making the case that this reading has reset to what we would call an oversold condition in a bull market environment. Now, it was as high as 90% last December. It was in the mid 70s when I was on in July. And now it's coming off a reading of 50%, which marks the lowest participation in a year. So while some may see this as a concern, we see it as an opportunity based on where we think we are in the equity cycle. We think we're 18 months into what is typically closer to a 30-month bull cycle. And if this is still a bull market, as we believe it is, the reading usually doesn't reset much more than it already has. So with seasonals improving here in the fourth quarter as well, this is one of the reasons we are positioning for a rebroadening of this advance.
And it's interesting, as you mentioned, right, in some of the pullbacks you saw, like in 2016, 2017, you really didn't get much below that 50% level. It's kind of right where we're at right about now. Your second chart is looking at some leadership areas or lack of leadership areas, the NASDAQ versus small caps. Talk us through this one.
Yeah, I got the NASDAQ in the top panel, Russell 2000 in the bottom. And these are the two pockets of the market that have really been at the opposite extremes, the leader and the laggard. And I think they both tell an interesting story. So first for the tech-heavy NASDAQ 100, this has represented the side of the market that was really resilient to the internal correction that's been going on since at least June, when several of our breadth measures last peaked. Now, one prior dilemma was that this small cap weakness, we all saw it, we've been talking about it for a while, it hadn't spilled over into large caps. Well, that all changed in September. So how we think about it, when there's nothing left to sell, investors sell the leaders, which is why we think September's pullback is occurring towards the end of this decline rather than the start. Now, then also consider that the Russell has been flat for the last 8 months. Now, granted, you want to see the rally above the March high to confirm the move and to confirm the continuation of this cycle. It's a range until it's not, but it's this breakout potential for what we would call the market soldiers that represents the firepower we see for equities broadly, looking out into the first half of 2022.
It's such a great chart. It's amazing. I mean, you know that small caps have not been a great part of the market, but just looking at the chart and seeing the lack of upside when so many things have just been going up and to the right, it's really a stark contrast. So I know, Ari, you work a lot with institutional investors. When you're thinking about where you place your bets between now and year end, if we are in a sort of the pullback mode and a bullish phase reemerges going through year end, where are you looking for opportunities? Is it places like financials, which have started to run higher and higher rates, or is it an opportunity to buy things like Facebook, good companies, good stocks at a discount? What are you looking opportunistically between now and year end?
I mean, to answer your question, we like both those ideas, really depending on time horizon. I mean, given the uptick in interest rates, we think the 10-year is going to 1.75, maybe to 2%. You got to break out oil. I think these reflationary themes are breaking out here and look terrific. And this is what we recently upgraded in our portfolio. We upgraded the banks, which are really reemerging from big breakouts above their year 2007 peak. At the same time, when rates are going higher, the market's embracing beta and cyclicality. We get it. Tech won't be the top performing sector, but we do continue to believe that sector should produce some of the steadiest returns through the course of the cycle. We argue it is an offensive sector, while really it's the true defensives that we think are most vulnerable to underperform. So it's a bit of that barbell. High growth I think is still the core position for the long term, but you want to own the banks and all the reflationary themes here into year end.
Ari, it's always a pleasure to have you on. Thanks for making this seem so easy in terms of putting things into perspective. But I know there's so much that goes into how you're thinking and what you're sharing with us. So listen, be well, stay safe. We'll talk to you again soon. All right.
This is so much fun. I'll talk to you next time, Dave. Take care.
That's Ari Wald. There's the chief technical analyst at Oppenheimer in New York. And again, if there's one thing I missed about my time as an institutional investor, it's having guys like Ari that would come through the office who would be able to chat with often. But I think if you listen to how we talk about that last part, I think that's key, right? I mean, how would you position yourself thinking about potential further upside? I think the right answer, as he was alluding to, it's what charts are starting to work, and I think you're seeing some of those financial names starting to work. But again, technology, as he described, could be some interesting true offense as well, as he put it. Let's continue on today's show with our final bar mailbag game. These are all questions that we've gotten from you in the last couple of days. Really appreciate you sharing your questions with us. As always, get your questions to us via email is the best way. The final bar at StockCharts.com. Let's get to it. Question number 1. I've been playing around with some additional charts for daily review. Do you see any utility to the use of these perf charts, performance charts? And you shared with me a couple that I will share with all of you now. Here's chart number 1, which is the S&P advanced decline line, and actually a bunch of different advanced decline lines. So the S&P AD line is here. Then you have a bunch of different AD lines, and you're actually looking at it on a performance basis, which is actually an interesting way to do it. Chart number 2, let's see, the S&P and then breadth indicators also on a performance chart. Yeah, that's a really interesting question. So, is this helpful? If you were looking at nothing else, I would say absolutely. I don't think necessarily looking at them on a performance basis, on a percentage return basis, has a lot of value, particularly when you're looking at things like AD lines, especially when you're looking at stocks above their moving averages. Those are already defined in terms of percentages. So the value, the actual value of the percent of stocks above the 50-day, it's a percent already. So you're actually here doing a percent of a percent. So while it will help you see the directional trend, and that's why I don't think it's a horrible thing, I don't think the values really have any meaning. And I think you would get, at least I would get the same thing out of putting them, just as a regular chart, just looking at the shape of these, but certainly paying attention to the trends in the AD lines and especially the trends in these breadth indicators. Absolutely right. And if you caught it, Ari Wald was talking about this indicator being at the 50% line. And so I think that's actually something I would absolutely be paying attention to for sure. But in that way, I would be looking at the actual values. I don't think looking at them using perf charts is necessarily adding a whole lot. I would actually think it probably confuses it more than anything, but visually, that's what I would be paying attention to. Question number 2, $XAX, the AMEX Composite. Boy, that is one index we rarely refer to on the show. So let's bring that up. $XAX, there it is, the AMEX Composite Index. It's really improving on major indices RRG. Do you happen to know an ETF that tracks XAX like the Qs do for the NDX or the SPY for the S&P 500? Yeah, so the $XAX, a lot of people don't refer to it as much, and I'll tell you why in a moment. This is an index that was really much more popular back when the American Stock Exchange was a thing. And I remember early in my career visiting the floor of the American Stock Exchange, the AMEX in New York. It's not too far from the New York Stock Exchange. It was pretty lightly attended when I was there, and this is probably early 2000s. But since then, it's really sort of it's gone away and it's been absorbed into other markets essentially. But the AMEX Composite Index is still tracking. As you can see, it's actually making new long-term highs here again this week. So is there an ETF that tracks this? Not that I know it. I mean, if there is, if someone wants to write in and let me know, I'd be fascinated to know. I don't know of one. But however, I would think I would ask the question, what are you trying to get exposure to? When you're looking at a chart of the AMEX Composite, in a lot of ways, it's going to look similar to a small cap chart. It might be even looking a little more like micro caps because the American Stock Exchange tend to be really small, like nano caps even. I mean, really, really tiny companies that were all not big enough to get listed on the New York Stock Exchange. They would get listed on the AMEX. So I would imagine if you look at like the micro cap ETF, you'll probably get a very similar performance characteristic to this. But some of the bigger ones, it's sort of small cap energy names, if I remember right, from looking at the AMEX last time I did. So no, I don't think there's an ETF that does this. But I think if you think about what exposure you'd actually be getting, I think there are ETFs that provide that exposure to small and even micro cap stocks. And I would think a micro cap ETF probably tracks this pretty well. But that's what I would be looking. Next question, what do you think is causing these last 30 minutes of selling for the last week or so? It's a really good question. It's actually a question we had last week and we didn't have time for it, but I did want to bring it up here. Let's look at the S&P and let's look at, an intraday chart might be a good way to, this is just a 5-minute chart. And here you're showing just on the last couple of days. So this is today's trading, this is Monday, and then last week, Friday, Thursday, Wednesday. And if you look, 4 out of these 5 days, last 4 days, the last hour has certainly been distribution. So in general, you would think of the market, the shape of volume on the trading day sort of has a U shape, and you have a lot of volume in the first 30 minutes, a lot of volume in the last hour, and it tends to be a lot later. And the closer you get to lunchtime Eastern. And that's basically because first thing in the morning, you sort of think of that as the retail traders, when a lot of people are reacting or overreacting to overnight news, earnings releases, headlines, economic data, all of that kind of thing. The institutions are really making changes at the end of the day more often. So I would say the big players that are making changes at the end of the day are institutional investors changing positions, and also ETFs that are rebalancing that'll happen in the last 30 to 60 minutes. So It's an interesting thing to look at the last hour and assume that that's more institutions. Look at the first 30 minutes and assume that that's more retail investors. And while I'm completely generalizing, overall, that tends to be a pretty good way of thinking about it. So distribution at the end of the day is suggesting institutions are rotating out of the market overall, but what the question is what they're actually doing. You have to remember that depending on what bets they're making and how they're rotating, it could be just a rotational trade that is getting picked up with the S&P going lower. Maybe they're going into smaller names or something that wouldn't be reflected as much on the S&P stocks. They might be putting risk on that would actually make the S&P go down. If you see things like small caps rallying into the close, that's something that could be indicating. But overall, that indicates more of a risk-off posturing for institutions more than anything. And so in general, I would feel much more optimistic about market upside. And I think that could be one sign of the market improving from here, is if you see those last 30 to 60 minutes improving. That's all the time we have for questions. Boy, I always wish we could get to so much more. We'll get to more questions next week on Tuesday's show. And again, get your questions to us via email, thefinalbar@stockcharts.com. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is Home Depot. I'm sharing with you 3 individual names. I enjoyed talking with Ari Wald, as I always do. He's a fantastic strategist, really knows the markets well and knows the technical toolkit as well as anyone. But we were talking sort of big picture and talking about some of the leadership themes going through year end. I will summarize this market environment in 3 charts, so I will attempt to do it in 3 individual stocks. Chart number 1 is Home Depot, and this is an example of a chart that when the first 2 charts sort of tell me what stock should start working if the market is improving from here. I think the base case for me is similar to what you heard Ari talk about. We've had short-term distribution, a well-deserved pullback. I think seasonally, November, December tend to be very, very strong. I think strong likelihood that we rally into the end of the year. And the question is, what confirms that is starting to take place? I think starts like Home Depot, not just hitting resistance, but breaking through resistance would be an indication that is actually happening. So far, what we're seeing is sort of a cup and handle-like pattern. We have a rounded bottoming pattern. You have a resistance level. We now have a shallower pullback, retesting that same resistance. You call this a basing pattern, and we're potentially rotating to new all-time highs here. Stocks like Home Depot making new highs, the new 52-week highs list expanding, that would be an indication, an all clear of sorts, showing you that some stocks at least are able to make new swing highs, new all-time highs, new 52-week highs. So Home Depot is one chart I would certainly be looking. Chart number 2, and I even mentioned Facebook with Ari to see if he would pick up on that, and he did. He talked about sort of the growth trade and the overall technology, internet trade. But I think Facebook is a fascinating chart that helps illustrate the conditions that we're in right now. This is a stock that was very, very strong in the second into the third quarter, making new price highs, making new relative highs above its 50-day moving average. All of that has changed. It's now gone below the 50-day moving average. It's made new swing lows, made lower highs, and the relative strength has gone down. We're now testing the 200-day moving average. If you know your candle charts, that's a hammer candle, and you can't really see it that well, but that's what it is. Suggests a short-term bounce, which would be reasonable in any environment off of the 200-day moving average. I think for me, the question is whether Facebook stays above this 290 to 300 range. If it does, if it finds support there, that means it's finding support at a big round number. It's finding support at the May and April lows, as well as the August and November highs from last year. That would be a very reasonable point between here and 290 for something like Facebook to find support before rallying to new highs coming off an oversold condition. If Facebook cannot hold 290, I think that tells you in some ways all bets are off. That tells you that the growth rate is not working between now and year end. You really need to think about the potential for further downside for the market as a whole. Finally, the XLRE, you got a bounce today. It was the #1 S&P sector. I wouldn't read too much into that because that is just today's move. It's all about the overall trend. And overall, real estate has been in pullback mode, along with other things, some of the growthy sectors. The XLRE is bouncing off of 44. The relative strength was very strong through June and now has been incredibly sideways. The question is, does this sector start to emerge? I mean, one thing that would tell me that the rally into year-end thesis is incorrect or not likely is if something like real estate really starts to push to the upside. Now, granted, the market can do just fine with real estate leading, and we saw that in the first half of the year where real estate was one of the better sectors and the S&P making new highs. But in general, I would be looking for potential for market underperformance with strength in real estate. Folks, that's our show. For everyone here at StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.